Hello and welcome to the Look Ahead with me, Fiona Singh-Cotter, Senior Market Analyst at City Index, looking ahead to the week ending, or starting, should I say, the 24th of November, the final week of November. So as always, just going to ask you to have a quick read through the risk warning before we get started. I'm just going to pop myself on mute whilst you do that. Okay, so without further ado, let's crack on. And as always, just having a quick look here at what's been going on this week before we move on to expectations surrounding the week ahead. So I think it's fair to say that it's been a risk-off mood this week. I mean, we've seen risk assets sell off fairly sharply. This is the S&P 500 chart that we're looking at here. Now, a couple of causes behind this: the AI valuation concerns, as well as hawkish Fed expectations or speak, have helped send the three major indices lower. At one point, three major indices were down between 5.5% and 8.5% below their recent peaks, and this is really highlighting just how jittery the market is. Interestingly, Nvidia's earnings, which were much better than expected, and upbeat commentary as well from CEO Jensen Huang, actually failed to sustainably reverse the negative momentum, and investors continue to really question rallies, seeing as selling opportunities, particularly because of concerns surrounding those AI leaders and investment announcements, you know, the idea of the circular spending. So I think, you know, should these AI concerns continue, it would be difficult for risk assets to meaningfully rally. So that's one side to think about. Then also beyond the AI, you've got the minutes to the FOMC, which were, or had a slightly more hawkish stance, sending the December rate cut expectations down to just 27%. Now, if we think these were up at 90%, so almost a certainty ahead of the October meeting, and now they're down at 27%. So we've seen a rapid repricing there of rate cut expectations, highlighting just how carried away the market had gotten over the that period. And so policymakers very much have highlighted the lack of recent data as an obstacle for further rate cuts. That includes the you know, the fact that we did have the September non-farm payroll, but we're not going to get the October non-farm payroll. We're not going to get the October CPI report. So just as far as the September non-farm payroll was concerned, it wasn't actually that bad. I mean, it gave off mixed vibes. We saw job creation of 119,000, which was well ahead of the 50,000 that investors, the market was expecting. But at the same time, we did see unemployment rate increase unexpectedly from 4.4% to 4.3%, sorry, from 4.3% to 4.4%. So there was some sense of weakening, but I think broadly speaking, what this data showed us was that in September, the jobs market supported the Fed's view that it is cooling but remains stable. And that's really done little to add clarity over when the Fed will be cutting interest rates again. It doesn't support a December cut at all. So that's what's been happening, and as a result, as I said, we've seen the S&P 500 fall down to here, testing this level here. This is the 6,500, the low that we saw back in October. Looking a little, I mean, it's still early in the day, but we see a doji candle there, so a little bit of indecisiveness, but this was very much a bearish engulfing candle here. We've got the RSI below 50. So this is, you know, pointing to a bearish position. If we can break below this level here, if we get below 6,500, then we could be aiming towards 63.50, 63.60, which was the low that we saw. Was the low that we saw here in September. And then below that, you've got the 6,200 and the 200 SMA coming into focus. If we do find that this level holds, then on the upside, immediately on the upside, 65.75 could be a level to watch out for. But really, you know, we need to get above the 67.65 level to have any sense of a stabilization in the recent sell-off. So that's the S&P 500. Let's just take a quick look at the US dollar, because the US dollar, look, it's moved above its 200-day SMA. It's testing this resistance here, but it did actually move up to a 6-month high of 100.36. So I'm wondering, actually, you know, given the environment that we are of that slightly risk off, given the markets sort of selling out of the yen as well, you know, the US dollar does appear to be the preferred safe haven as far as the US dollar and the yen is concerned. We'll have a look at that chart shortly. But we are seeing that that's sort of where the flows are going. And I think the current environment potentially does support the US dollar for further gains if we continue to see that risk off mood. Interestingly, gold has also fallen across this week. We can see it's just, there's this longer term trend line that dates back to August. Just actually breaking below that at the moment, testing this level here around the 4,025 sort of region. If we get a break below there and the 4,000 level, then we could actually see a decline back towards that 3,880 level. Because it's interesting, we're not really seeing the gold pick up safe haven flows. That's obviously because the Federal Reserve is adopting that slightly more hawkish tone, which is weighing on the gold, also because we've got that US dollar strength as well, which is not favorable for US dollar denominated gold. I think for those reasons, we're seeing gold come under a bit of pressure. So let's move on to next week and what we'll be watching. This is the economic calendar for next week. I've just filtered it down for importance, and this is the week ahead. So on Monday, well, this week we do have the return of US data. I mean, we have had it a little bit this week, but not really. I mean, it's back this coming week. As I mentioned, we don't have the CPI report or non-farm payrolls for October. But we do have other data to be getting on with. US retail sales expected to show 0.4% increase after 0.6%. This is September and August. And PPI. PPI will be sort of one of those inflation points that we do get to just keep an eye on in order for the market to have some sort of sense of where inflation may be sitting. Obviously, PPI, the cooler it is, that often feeds through to CPI, which can point to a cooler CPI in the coming times. But obviously, a hotter PPI could point to, because PPI is wholesale inflation, could point to hotter consumer inflation down the road. So definitely figures to be watching out for. I think any sense that retail sales are holding up and that PPI is holding up is potentially going to give the US dollar a boost. And I think just having a quick look back at that chart, that could give the US dollar a boost. Next levels to be watching out for are going to be around here, the 101.75 or the 101, just bear with me, around the 101 a 102 level even. That's sort of the high that we saw back in May. So that's a level to be watching for on the upside. Obviously, if we do see a surprise weakening in data and an improvement in risk sentiment, which seems unlikely for the time being, then we will be looking on the downside this level here. This is the 20 SMA at 99.55. and that's also a high that we saw back on the 9th of October, 99.55. So that's a level to be watching out for ahead of the 50 SMA around the 98.80 level. So yeah, that's as far as let's just have a quick look as well at what's going on, what this would all mean for oops a daisy, the NASDAQ. This is NASDAQ here. Look, falling below key levels. So this is the sell-off in the tech sector that we are very much seeing here. And I think the other thing to keep in mind here as well, and I'll talk about a bit more about this when we get to Japan, but Japanese yields have pushed up very sharply with some tenors at record levels. I think the 20-year Japanese bond yields at a record high, 30-year as well. Now, what this means is there could be a potential ending towards the carry trades. The carry trade is when, given the low rates that we've seen in Japan, or there have been in Japan for a very long time now, you know, the carry trade was using funds from Japan, selling out of Japan in order to fund investments elsewhere where the rates of return are much higher. Now, with government yields rising significantly in Japan, that could start to undo. Now, it isn't necessarily at the moment. We're still seeing the yen quite weak on the back of what's been going on, but just saying that one of these sectors, tech sector, crypto, that tends to be very vulnerable to those liquidity flows. So if we do start to see liquidity drying up because of what's going on in Japan, then that could also continue to put pressure on stocks. As far as earnings are concerned, we do have some earnings next week, but just at the very end of earnings season, there's Zoom, I think, as one of the ones to be watching. But this is the NASDAQ. Series of higher, lower lows and lower highs. We're testing or breaking through this level here of 24,000. That's the October low. Next level to be watching out for on the downside is going to be the 23,000 level, which was the low that we saw back in September. So that's the next level to be watching out for. If we're finding that this level does hold, the levels on the upside we're watching for 24,600 or 24,550, and then also this one here, 25,300. That's sort of like the high that we saw this week, and a rise above that would create a higher high. Other things to be watching out for. Let's just talk about the USD Japanese yen whilst we're here and whilst we're talking about briefly what's going on in Japan. We do actually have Tokyo inflation this week from Japan. Tokyo inflation, I mean, we've also just had this week announced huge stimulus efforts. At the same time, we're getting mixed messages from Governor Ueda from the Bank of Japan over the timing of the next rate hike, which obviously combined with the new Prime Minister Takeshi announcing stimulus of $135 billion US. So that's the largest since 2022. This is the reason that the yen remains under pressure. Now, even I think an upside surprise to Tokyo inflation is unlikely to really boost the yen in any significant way. Now, we are hearing threats of intervention from the Japanese government, which could mean that, you know, the ascent in US dollar Japanese yen is slowed. But I don't think that would necessarily be a deciding factor. I think what we do need to just watch out for is, as I said, the unwinding of carry trade, and that may strengthen the Japanese yen, but it's not happening at the moment. Just something to be watching out for. We're seeing the US dollar Japanese yen rose to a 10-month high of 157.90. It's just easing off slightly, testing that 156.85. That was a high that we saw in late January. and that's just pulling the RSI out of overbought territory. But this is, you know, it's a bullish chart. So if this level holds, we might get down to here, but this is just going to be seen as opportunities to buy in rather than to sell at the moment. Levels to be watching on the upside, the target there will be 158.90. That was the high from, here we go. That was the high from 2025, January. Okay, that's level to be watching on the upside. On the downside, as I said, support levels immediately 156.80, and then you've also got that 155 level. If we get a break below here, 153, then that would negate that sort of near-term uptrend, and we could open the door to further declines. But it feels like we're quite some way away from there at the moment. Now, just sticking with currencies, we do have the UK budget this week. So it feels like we've been waiting for the UK budget since September. It has very much been nervous about what could happen here. I mean, data today showed that the government borrowing was at £17.4 billion. Now, whilst that was lower than a year ago, it was still the third highest on record and considerably more than the £15 billion that was expected and the £14.4 billion that was forecast by the OBR in March. Now, basically, this data really does reinforce those concerns of this black hole, which could be to the tune of 25-35 billion that the government needs to plug, and supports expectations for fiscal tightening and tax hikes from the Chancellor. Now, government, as I pointed out, government borrowing is very, very high. Gilt yields have been climbing, and we've also seen here, we can see the pound weakening quite aggressively in recent weeks. And, you know, I think this budget could very much prove to be a make or break moment. Aggressive tax hikes, whilst that might bring some calm to the markets, initially, it could potentially support or add to sort of a political crisis, challenging PM Starmer's ability to govern. You know, there have been quite a few rumblings about coups that may be taking place, and I think an unfavourable budget, particularly if we see income rates, income tax rises, that could, you know, going against the pledge of the government, could be pretty badly received politically. Now, the government has suggested, or Reeves have said, that she wasn't going to increase income tax, but that was before we got the spending data through. There's obviously been the downgrade in productivity in the UK. We've also got the GDP, which was weaker than expected. So this is just a really difficult corner that the Chancellor has found herself in. And it's, you know, excessive spending or very high spending, low productivity, weak growth, not really in a position where she can do anything more other than hike taxes, and obviously cut spending would be the other one. But I think given the attempts to put forward welfare reforms earlier in the year, that got shelved very quickly. So spending cuts doesn't seem to be a favourable way for the government, or they might struggle to get that past the backbenchers. So as far as tax hikes, the question is, will she be able to get to where she wants to go, just tinkering around the edges? And it seems questionable. And I think the problem being is that if the market, particularly the bond market here, doesn't think that the Chancellor can do it tinkering around the edges, then that obviously would be bad news for gilt yields, which could surge, or good news for gilt yields, depending where you are. Yeah, could send the gilt yields surging higher. And yeah, so I mean, you know, as far as sectors to be watching as well, as far as the FTSE, sorry, just finished with the pound actually. So the other thing to keep in mind here is, if we do get large tax increases, that's obviously going to act as brakes on the economy, which is already slow, could reduce inflation measures further, meaning the Bank of England will need to be cutting interest rates more aggressively as we head into 2026. Now, the market is already expecting, pricing an 82% probability that the central bank will cut interest rates rates next month following a softer than expected CPI report. We've already seen today as well, PMI data is showing signs that businesses are losing momentum ahead of the budget. So, you know, further rate cut expectations could pull the pound lower. What to be levels to be watching? This is a level here, 130, key level. That was the low that we bounced off earlier. Was it this week or last week? I think that was last week. Now I lose my yeah, last week. And so that's level. We break below that, 127. Next level to be watching out for. So quite a steep decline in sterling could be on the way. Watch out here, we could be heading for a death cross as well, with the 50 SMA coming, looking like it might cross below the 200 SMA at some point in a death cross signal. RSI below 50 supporting further downside until it goes into overbought territory. So yeah, if we get a break below that level, 130, that's what I'll be watching out for. Just as far as the FTSE is concerned, sectors and also to be watching out for. I mean, we've seen the FTSE fall off as well as part of the sell-off in risk assets this week. I mean, it has fallen quite significantly, to be fair, but and it's fallen below the 50 SMA, below that rising, out of that rising channel. But we have found some support around this level here, which is the 94.30 level. This is the level on the downside to be watching out for, 93.40. That was the high that we saw back in August. Has been a level that seems to have some importance in recent months. But obviously there's going to be things to do with the housing. So if we sort of see that we get mansion taxes, we might find that stamp duty is removed, so that actually may be good news for the housing market, could be good news for house builders. Banks are going to be very much focused on the yields and rate cut expectations. They're to be watching out for as well. So that, yeah, as I said with the FTSE, so if we get any expectations, I think, that or signs that the pound is weakening considerably because the budget is fueling BOE rate cut expectations, then that could actually be beneficial for the FTSE and the multinationals, and look for levels above the 95.70 to stabilize that and to bring sort of 9700 into focus. So just quickly moving on, there's quite a lot to get through. RBNZ. RBNZ will be meeting on Wednesday. They are I mean, sorry, it's been quite a while since we've looked at this chart, obviously. Let's have a look here. Let's put this back in here and get some more of these ones up. Okay, so just as far as levels are concerned, I think this is quite, we're just testing this one here at the moment, aren't we? So the yeah, so RBNZ, they are expected to cut interest rates by 25 basis points. Basically the RBNZ cut rates by a larger than expected 50 basis points to 2.5%. That was larger than 25 basis point cut that was expected in the October meeting. And also that means that they've eased now by 300 basis points from a peak of 5.5%. In the statement, the committee said it remained open to further reductions with an S, as it required inflation to sustainably settle around 2% target level. Now, the RBNZ downgraded the description of the economic activity to economic, suggesting that growth, economic activity was weakening or is softening. There was a softening in tone, supporting the view that the more rates are to be expected. As I said, expecting a 25 basis point rate reduction to 2.25%. The projections are expected to show a terminal rate of 2.15%, and the market is seeing a 50% probability of a further 25 rate reduction in February. So if we do see this slightly more cautious sounding, sorry, if we do see quite a dovish sounding RBNZ, then potentially we could see a further weakening, especially if we see that ongoing dollar strength. Now, we are at a pretty key level here. We've extended this downtrend, trades in that falling channel. We're just near overbought territory, so we could see a little bit of consolidation or a move higher. Testing 55.85, that was the level that we saw back here in February, the February low on several occasions. Break below there, you've got the lower band of the channel, but then you've also got this level here, which is the 0.55 level, which was the low that we saw sort of back in 2025 back in April. Any sense that they're starting to sound a little bit more cautious about further rate cuts, which we're not expecting, could see a move above this 78.6% fib retracement level. But I mean, you know, we're not really going to see some stability to get this in this downtrend. You'd need to get a move above the 58 level for this to really suggest that that downtrend, or that longer term downtrend, is indeed over. And then just finally, let's just have a quick chat about the euro and US dollar. And that is because we do have German inflation data, not really expecting anything major. It's expected to stick around that 2% target level of the ECB, which supports the view that the ECB is very much done with its rate cutting cycle. Growth is very much the focus now for the Eurozone, and I mean, it does appear to be moving slowly in the right direction, but what we're seeing here actually is the dollar strength playing out. But you know, if we look at, we have to think about where the euro is compared to what's going on with the sterling or the yen. Actually, the euro is quite muted as far as its downside has been. So just levels to be watching out for on the downside here: 114. The 68, so 114.70, that was the low that we saw for November. If we're going to break below that, that's going to bring this level in 114, which is the July low. But I think, you know, we're going to find that the US dollar is going to probably be the bigger driver of what's going on in this pair, given the fact that the ECB isn't expected to really cut rates anymore. But we do have some GDP figures out as well, and the IFO German economic sentiment data, which could be of interest as well. So excellent. Thank you very much for joining me today. I hope you've enjoyed it, and I'll see you next week.